Welcome back, everyone, to Lenders Online Training. It's a live stream, but I like to think it's a little bit of a podcast, so kind of go with me on this. My name is Dave Stauffacher. As many of you know, I'm the Senior Credit Trainer with Lenders Online Training. And today we're going to be chatting about a topic that looks simple on the surface, yet it generally gets some very interesting discussions in our credit review and our regulatory reviews. It's about commercial real estate. Now, we all know that our portfolios are filled with a lot of commercial real estate. It's kind of what we do. They're big loans, and some of them are owner-occupied, some of them are investor-owned. So that's today's topic. We're going to compare those two with a couple of situations. Now, let me give you a little context of our discussion. Two buildings, same size, same rent, probably same debt service coverage. One is going to be owner-occupied. One is going to be investor-owned. Now, lenders, regulators, even risk officers treat these a little bit differently. So we're going to dig into why they do that. And I'm joined with my colleague, great friend, fellow senior credit trainer, Joe Davis. Welcome, Joe.
Thanks, David. Great to be here. And let's just start with the punchline up front. It's not about the bricks and mortar. It's about who's actually repaying your loan. That's the tenant. On an owner-occupied deal, I can see the operating company. I probably have them as a guarantor, and I can underwrite that repayment source, right? But on a non-owner-occupied building, on an investor-owned building, the repayment source is a tenant I might barely know. I probably have really limited information on that company, maybe no financial information at all. And that difference really changes everything in terms of the underwriting and in terms of the risk profile, which is what we're talking about today.
So true, Joe. It kind of reminds me of the days when I was a banker. Many of you know that I have been in banking. I had worked with a credit that looked pretty good on paper. Strong debt service coverage. The appraisal was clean. Great condition property. Actually, it was a pretty decent location. But to my surprise, but after 12 months, the tenant actually left, to a surprise. And the owner of the property said, basically, we're just going to re-tenant it. Well, I think that kind of changes the dynamic here. We're moving from a loan that kind of stopped behaving like a real estate investment, but actually became more speculative. And that's the lens that we're actually going to be talking about today. So what actually changes here? Well, if I can step back a little bit, once again, let's get aligned with our definitions, a little bit of context, because the confusion often starts here. First of all, owner-occupied real estate. It's the operating company, and the real estate actually share the same ownership. Cash flows comes from the business operation. And it's quite common in today's community banking-like portfolios, right? The business operates, and strategically they set up the real estate as a separate entity, and they rent back and forth. We have it in our portfolios a lot. Now, non-owner-occupied real estate, this is where, can I say that maybe the landlord actually is the borrower? I mean, it could be an investment group. It could be, an individual LLC, but they're treating that as an investment. So the cash flows actually come from the lease of tenants. Joe?
Yeah, really good points, David, and nice job kicking us off. But here's the key phrase to remember. The tenant is the real paymaster. Okay. In non-owner occupied real estate, your borrower is essentially, I would think of them like a pass-through entity. The tenant ultimately repays your loan, albeit indirectly, through their rent payments. If you can't underwrite the tenant, your underwriting cash flow you can't really validate. And that's the concern.
Excellent. So borrowers will often tell us that it's, you have a lease, so you should be fine. What are you worried about? But in reality, the lease and the assignment of rents and all of those substitutes is not necessarily a direct relationship with the operating business. We don't know.
Yeah, it's about visibility and blind spots, and that's really the underwriting reality with owner occupied versus non-owner occupied real estate. And another key phrase here, owner occupied real estate is C&I lending in a CRE wrapper, excuse me, C&I being commercial industrial, CRE being commercial real estate. So owner occupied underwriting should really feel very familiar because it's essentially C&I underwriting. You're underwriting an operating business, right? You're evaluating with a full financial package. You're running a global cash flow, both entities, maybe some personal guarantors as well. You're looking at that EBITDA quality and the quality of earnings and the consistency of that. You're looking at the balance sheet with working capital, leverage, all of the ratios and numbers that we crunch with those deals. And then, of course, you're looking at your fixed charge coverage or your debt service coverage ratio. This feels like a C&I deal because essentially it is. The real estate is just the collateral wrapper around a business credit of an operating company.
I mean, even today with the companies that I work with, it's as if the real estate could be on the balance sheet of the operating entity. It could be. We just happen to move it over there. We actually do it globally. When we do financial projections, we actually include it all together. So it's kind of in there. It's just part of an asset of business, but it just has a slightly different name. Great.
Yeah,
I
for
love
sure.
that.
They do that for liability reasons. You separate out the operations from the real estate. That way, the operating business is not liable for any incidents that occur with the real estate. But that's why we as bankers take both of them as obligors on our loan.
Awesome. So on the flip side, if we go to non-owner occupied, it's interesting the fact that as investor real estate, we basically only have the relationship with the borrower or the investment group. They have the relationship with the tenants. I don't see the tenant financial statements. I would hope that the investor group has done some type of due diligence, but I don't see that. The location is, I don't necessarily know the specific location and the impact and its financial performance of those tenants. I don't know anything financially as to, we talk about the paymasters in this case, or the tenants that are very important to making the payments. That's the rental stream, but I don't know their financial position. I don't know what their leverage is. So it's very difficult. Now, in some cases, if we have a very large, well-known tenant, it could be a pharmaceutical company like a Walgreens or CVS, whatever, those big companies, right? You can pull a financial report if you want to do that, or do some type of internet search to at least give you an idea. Well, that tenant's pretty strong, but it's basically just best guess underwriting. So once again, I would hope the investor group has some type of due diligence for the process, but we're never going to know, right, Joe?
Yeah, I like what you said. You have to do some due diligence, even if you don't have a full financial packet. I mean, we live in the information age. You can find a lot of information on the internet, clearly. But even with those public or national tenants, you often don't get kind of store level or local level economics. You don't know how that individual location is performing. So a tenant can look strong on paper while a specific location is just absolutely failing or bleeding cash. And many of those big companies will have separate, smaller divisions for each location or even for each region. So the parent company, Walgreens International or whatever it's called, it might not be liable for lease payments on your individual property. The tenant, that's really what I like to think of as the tenant black box.
Wow. I know we've talked about this before, and it's kind of a key line that you've said before, that the tenant actually is the paymaster, right? We just want to understand that even in all the properties that we do, the loan agreement that we sometimes as lenders feel comfortable with, it's kind of the lease. Mm-hmm. Now, the lease has a lot of specifics in it. It's important for us to read it, review it. It'll give us a little bit of the term, whatever versus the loan maturity. Now, in some situations, many of you might be SBA lenders. You know that the SBA requires that lease matches up with the term of the loan. They don't want their, the driver of things, of the payments to be kicked out at any time. Sometimes those lease terms will have options, extension options. But I think it's important to know that just because it's in there as an option, the key option, it's not always guaranteed. So I don't think we can get misguided thinking, oh, this is going to be continued for the long-term part of the loan. Sometimes there's rent escalations, and I think that's probably important to understand. And then, of course, you get into the ones that most common. Is it, is it gross rents? Is it triple net? What are these cap rates, and who all pays for this type of stuff? So the lease is important, right, Joe?
Oh, absolutely. And I like what you said there. Extension options are optional. You can place weight on them. You do want to see them, of course, but keep in mind that's an inflection point, and the lease can not be renewed at that point. It's certainly optional. Now we're talking mostly so far about kind of single tenant properties, and that's really the easiest way to think about it. But when you get into multi-tenant properties, that really multiplies the risk. So now you're reading 5, 10, 15 lease agreements. You're analyzing tenant concentrations. You're looking at things like weighted average lease term, those extension options, and certainly rollover stacking. So you have not just one entity you're dealing with. Now you're underwriting potentially 10, 15 different entities and 10 or 15 different leases. And some risk can come in that world as well.
You have to really think it as an underwriter, and many of our analysts here that are on the viewing this is, you would think the more leases, the more tenants, the more diverse it is. That's a good thing for our revenue stream, but that means we really need to understand all those tenants. We'll have to schedule all the differences, and just to try to understand that can be, quite honestly, overwhelming for us as an underwriter, but I think it's an important part to do that. So,
yeah, for sure.
We talk about a variety of tenants, and this is interesting in the sense that we talk about affiliations of who that landlord is. For example, let's say we're dealing with the government. Sometimes there's a lot of you will see commercial properties where it is leased to a governmental agency. Sometimes those leases have some unique wording in it where they can terminate it for convenience. We talk about other tenants where there is other triggers that may develop in a retail environment where there's termination buyouts. So I think, in essence, if we can really look at this, it's important for us to obtain all those leases and understand as to how it fills into the cash flow, understand as to the potential risk, I would say, inflection points that could happen throughout that impact our ability and assurance that revenues are going to be ongoing, right? Because we're in these properties for an extended period of time, 15, 20, 25 years. We're in this for the journey, and knowing that there are certain points where we have to be aware of.
Yeah, one thing you said there really rang true with me, David, and that's government leases. They're really notorious for being easy to break. Those termination for convenience clauses in them. I used to loan a lot of money in Springfield, Illinois, state capital of Illinois. So a lot of my customers were leasing to state entities, but they had essentially a very easy out at, I think, 30 days notification. They can just leave. So you really have to take that into account and underwrite to that. And also think about, I'm not going to get political, but think about Doge. Doge was pretty hot a year or two ago. They came in and just canceled a bunch of federal leases. And so those government leases are very typically flimsy at best, is probably a good way to put it. Now, that being said, a lot of those entities have been there for years and years. And so you do have to take a little bit of subjectivity into account as well, and figure out if they could move, where they would move, how hard that would be. But that's the underwriting we're talking about, how you're going to get comfortable with that. So next, I want to talk about structuring. Structuring, not an option. It's not optional. Trace the cash flow to its source. That's the theme of the day. So for owner-occupied real estate, you structure that like a commercial and industrial loan. You get the operating company as a guarantor. The assignment of rents is not adequate protection for the loan. You really do need that guarantee. It's more of a direct line to the paymaster or the tenant. You can put direct covenants tied to business performance on that operating company. So, hey, they need to keep DSCR of X for the life of this loan, for example. And then you can also cross default with the operating company debt. So you have both entities as obligors on different debts. You cross default those. And in certain situations, you can actually cross collateralize those debts, or take a secured guarantee is probably more common. But in a nutshell, act as though you're lending directly to the tenant, because economically you essentially are, right, David?
That's you bet. Oh, that's great points on that as far as how we tie everything together. And sometimes when we're trying to do all the structure and all the documentation, it can be a nightmare, but it all needs to be done. All that I's need to be dotted, T's need to be crossed. So I'm going to flip on this side. I'm going to go back to non-owner occupied. For this type of real estate, I mean, I think structure is utmost important. It's your protection. So some of the things that we have come across over the years would be likely it's going to be a lower loan to value. Maybe it's 65% that we would get into these. And there's a reason for that, right? Because of the inherent risk when you're dealing with someone that you don't know their financial position. So most likely it's best to have a lower LTV. Now that's according to your guidelines, but that's what we would probably reach out to. Personal guarantees of the investors or the investor group, whoever is the so-called borrower, we need those and all the ties that are. I think assignment of rents is very, very important. We need to have an understanding that we are connected to those tenants, despite not knowing what their financial standing may be. We want to put some provisions in there that if there's some go dark provisions, that's very important. If things change with that property significantly and we know it impacts our ability to get rents, we need to be able to take some action. Now, another agreement that I don't know many of you that are on this call that would know is SNDA agreements. It stands for really subordination, non-disturbance, and attornment. Basically, it's a relationship between us as the lender and the tenant. So if something happens with the borrower, it still keeps us into access because we have an interest in the property. We have to be, the tenant has to acknowledge that we have interest in the property, but we as the lender also need to be respectful of them, that we just are not going to go in, kick them out, but we also want to make sure we have that relationship understood that if that event would occur, this is how we're proceeding forward. Is that right? I mean, am I close on that?
Absolutely, and you can see by the name of that document why we use an acronym. It's a mouthful. You're right. It's very often misunderstood and not often used, especially by community banks. But it can provide a lot of protection. It gets everybody on the same page on the front end while we're all still getting along.
Yep, very much
which is good. The other thing I'd point out as you're talking about loan structuring with non-owner occupied deals, David, is the SBA will not allow non-owner occupied real estate to carry a guarantee. They deem it to be passive income, so they are ineligible for SBA guarantees. When you're talking about loan to value, that's actual equity they have to come in with rather than, say, a 504 loan, for example. So just wanted to add that.
Thank you. Great.
Yeah, and this gets me thinking about some real world scenarios and some things that I've seen in my career. And I'm sure you've seen some things too, David. But let's say a restaurant, for example, because I think that's a really good way to frame it up and think about these types of things. You have owner-occupied real estate. You underwrite the operator. You have visibility into their experience, their track record, their history, and most importantly, you have financial statements. You can see indications of consistency and financial strength, leverage, cash flow. Now, on the flip side, non-owner occupied real estate, you're relying on a lease from an entity you might not know much about. Tenant might be inexperienced or thinly capitalized, or maybe generating inconsistent earnings, maybe some seasonality involved there. And the restaurant industry is historically volatile. Right? It's one of the classic examples of a volatile industry. So we don't then need to layer on underwriting or loan structure risks on top of already having a volatile industry. So that's why I think about restaurants in this context.
I agree. I think another field that kind of comes about is the medical world, right? Sometimes the medical offices per se are very specialized and they're owned by the physicians sometimes are owning that, which would kind of be a strong alignment to be able to do that. But what if the hospital system is part of the tenant? I mean, it may be a strong credit relationship. You may think that because of the hospital system, but it could be some strategic risk that you may need to be aware of. Because once again, we kidded about the the CVS is there's kind of ways that they get out of these tenant relationships, and we're stuck with four walls and a roof on that. Any other?
Yeah, I'm just on that last point. I always think about the very large national or international companies are going to have better lawyers than the community bank or credit union. So if you think they can't get out of that lease agreement, they have some very high priced legal counsel on their side.
Yes, they do. Yes, they do.
I also think about strip centers or strip malls, David,
Yeah.
when we're talking about this. That's just a classic trap. So one tenant leaving doesn't just reduce the NOI, the net operating income. Re-tenanting costs and downtime can really exacerbate that impact. And if the anchor tenant leaves, the big tenant in the corner that draws all the traffic there, if they vacate, those secondary tenants probably aren't too far behind. So I like to think about that as well.
Awesome. All right. So I guess the question that I would kind of reach out and point to many of our lenders that are on here today is, if the tenant fails, remember the paymaster, what's your recourse? How fast can you get cash flow coming back into the system? Because that's what we lend on, right? Even with our income tax training class, we talk, it's all about cash flow. That's what repays the debt. So if it fails, what is the recourse? And that probably is the underlying theme of any underwriters that here. We need to think that fast.
Yeah, good point. And switching gears just a little bit, let's talk about the regulatory environment and why regulators look at this and why they care. So when examiners ask about owner-occupied versus investor real estate, they're not just kind of checking a box. They're really testing whether you actually understand things like cash flow durability and the inherent risks that are involved with this type of lending. So regulators track non-owner occupied real estate concentrations because these loans fail differently. Loss tends to be very severe. It tends to be higher in these situations. Cash flow collapses really quickly upon vacancy. And then that re-tenanting process, getting a new tenant in place, those cycles sometimes take a long time and might exceed your loan maturity, actually. So that's why our regulators are paying so much attention to this. And I think we as an industry should follow their lead.
Yes, re-tenanting cycles can take a very long time. By the time of, people leave, either you're going to go in and clean the place up, or it needs to be, if you get someone in there, it's going to take downtime to be able to get that property into with maybe some improvements that they can actually start renting the property. So your property could be vacant for at least 6 months. So thinking about that.
Yeah.
So I think portfolio wide, as our bankers have it, non-occupied real estate introduces risk, right? Correlation risk. Downturns, financial downturns, race, we'll talk about recessions. It doesn't necessarily hit just one tenant. It can hit an entire industry. Recessions have proven this over the time, and Joe and you and I have talked about in the past. Recessions, we know they're coming, just a matter of when. And most of us on this call have some type of recollection with what COVID was. Just imagine what COVID did, and we can look at it today, how it impacted our, commercial real estate. People didn't go to work, and then basically a lot of us are online. We didn't need to go back to the office, so it really changed the whole dynamic of non-owner occupied real estate. Wow, so that's why I'd like to say the acronym. Yeah. So those are things that we want to be able to consider when we're underwriting those, when we're having those discussions in our loan committees and credit reviews. Mm-hmm. So I'd like to close out our discussion with one thought. The next time that you see a commercial real estate opportunity and deal, ask yourself, ask your colleagues, or whoever's at that table, who is the real tenant? Or should I say the paymaster? And if someone on your team struggles with that, and they might, depending on their level of career, or they just maybe take things for granted, may explain, that they're unable to understand the risk of it, structure of it, the changes between owner occupied. So if that happens, what comes to mind, Joe?
Yeah, David, that's a really strong indication that clarity and training are needed, because the same building can be low risk or high risk depending on who occupies it and what the lease actually says. So if today's discussion raised any questions, or if you're dealing with a credit that maybe just doesn't fit neatly into a policy or structure box, that's exactly why Ask the Experts exists at Lenders Online Training. You can submit real world questions, get perspective from experienced lenders like David and me, or our founder, Linda, and you can really pressure test your thinking before a committee or before a regulatory exam. So engage with Ask the Experts at Lenders Online Training, and make sure your next CRE decision is grounded, it's defensible, and it's well reasoned. So thanks for joining us today. Stay grounded, stay curious, and we'll see you next time.